Did you know that somewhere on this planet, someone is cracking open a bag of Doritos right now? And a second ago, someone else did the same. PepsiCo sells north of 40 different billion-dollar brands. And this week, we found out their biggest comeback story just got real.
The North America snacks business turned positive for the first time in over 2 years. Volumes actually grew. After more than a year of price-fatigued consumers trading down, PepsiCo finally got the consumer to come back.
We are talking PepsiCo Inc., ticker PEP. Q1 2026 earnings reported April 16th. They beat on revenue, they beat on earnings per share, they kept their full-year guidance intact, and one of the most important volume metrics in all of consumer staples just flipped green.
I'm Lana Chen.
And I'm Hudson Thomas. This is Charged Alpha, the S&P 500 stock encyclopedia. Let's dig in. Let me set the stage on PepsiCo, because this is a company so embedded in daily life that it almost disappears into the background. Founded in 1898, 128 years old, it started as a soda company and grew into something far larger.
Today, PepsiCo operates through 7 segments, spanning beverages and convenient foods across virtually every country on Earth. In North America, the big 3 are Frito-Lay, Doritos, Lay's, Cheetos, Tostitos, then PepsiCo Beverages North America for the drinks side, and Quaker Foods for oatmeal and cereals. Then they have 4 international segments covering Latin America, Europe, Africa and the Middle East, and Asia Pacific.
Revenue runs at roughly $95.5 billion on a trailing 12-month basis. 319,000 employees, headquartered in Purchase, New York. Market cap around $215 billion.
The competitive moat here is distribution. PepsiCo's direct store delivery trucks pull up to hundreds of thousands of retail locations every single day. That infrastructure took decades to build, and a startup cannot replicate it. Shelf space is the scarce resource in consumer packaged goods, and PepsiCo has locked in premium placement at scale.
It is also about the brands themselves. When consumers hear Gatorade, they think hydration. When they hear Lay's, they think chips. That brand equity compounds over decades and gives PepsiCo pricing power when times are good and resilience when consumer spending tightens.
The reason we're covering PepsiCo right now is that inflection in North America. Snack volumes turned positive for the first time in over 2 years. That's the milestone CEO Ramon Laguarta has been working towards since he started strategically cutting prices on Doritos and Lay's to win back consumers who had started trading down. It just started paying off.
The man steering PepsiCo is Ramon Laguarta, who took the CEO role in 2018 after building his career inside the company for over 2 decades. He came up through the international side, running markets across Europe, Africa, and the Middle East before taking on the top job.
Laguarta's reputation on the street is as a methodical, disciplined operator. Not flashy, but consistent. His strategic framework, he calls it faster, stronger, better, is built around accelerating new growth, driving cost efficiency, and integrating sustainability into the business model. Under mounting consumer pressure in 2024 and 2025, he made a deliberate pivot to price cuts on key snack products to recover volume, a bet that began paying off in Q1.
His Q1 commentary was notably upbeat. He said the consumer is coming back to PepsiCo brands multiple times, which is exactly what you want to hear when you've just made a strategic price concession on your biggest products. 300 million new consumption occasions in North America food year over year. That's not a rounding error.
The tenure at 8 years gives him credibility. He has seen this business through COVID, through inflationary spikes, through competitive pressure from private label. The volume inflection in Q1 is the first tangible evidence that his response strategy is working. Let's get into the financials. Starting with valuation, PepsiCo trades at approximately 24.5 times trailing earnings, price to sales at 2.26 times, price to book at 10 times, EV to EBITDA at around 17 times. Market cap around $215 billion, with the stock at $157.5.
How does that compare to where PepsiCo typically trades?
Those multiples sit in the middle of its historical range. Not cheap by absolute standards, but not stretched for a global consumer staples company with this brand portfolio, this geographic footprint, and this dividend track record. The yield at 3.6% provides a meaningful floor for the stock.
Walk me through the quarter.
Q1 2026 revenue came in at $19.4 billion. That's up 8.5% from Q1 2025's $17.9 billion. Now, part of that headline growth came from acquisitions, the Poppi prebiotic soda deal and new distribution of the Alani Nu energy drink. Strip those out, and organic revenue growth was 2.6%. Positive, but more measured.
And how did that land relative to expectations?
They beat. Consensus revenue estimate was $18.9 billion. They delivered $19.4. That's a $550 million beat on the top line. On earnings per share, the adjusted figure was $1.61 versus the street's estimate of $1.55. A clean beat on both headline metrics.
What about margins?
Gross margin on a trailing 12-month basis is running at 54%, operating margin 14.8%, net margin 9.2%. These are solid numbers. Return on equity is 40%. The business generates strong returns on the capital it deploys.
What's the cash generation story?
This is a nuance worth flagging. Q1 operating cash flow was just $41 million, essentially break even for the quarter. That looks alarming until you put it in context. Q1 is always PepsiCo's weakest cash flow quarter because they're building inventory ahead of the spring and summer snacking season. The comparable Q4 2025 operating cash flow was $6.6 billion. On a trailing 12-month basis, OCF is over $13 billion, and free cash flow is closer to $8.8 billion.
That's the seasonal pattern.
Exactly. It's worth noting, not worrying about unless Q2 and Q3 don't show the expected cash flow recovery.
Balance sheet?
Total debt is $52.7 billion, net debt $42.3 billion, cash on hand $10.5 billion. The debt-to-equity ratio runs at about 2.5 times, elevated but manageable. Interest coverage is 12 times operating income. Current ratio is below 1 at 0.9, which is actually normal for PepsiCo. They run a working capital deficit by design because they collect from retailers before they pay suppliers.
And the dividend?
This is a cornerstone of the PepsiCo investment case. 53 consecutive years of dividend growth, annual dividend of $5.69 per share, yielding 3.6%. The payout ratio runs high at about 88% of earnings, which is something to monitor. For 2026, management guided $7.9 billion in dividends and $1 billion in share repurchases, $8.9 billion in total shareholder returns. Overall, PepsiCo's financial health is solid. The debt load is elevated but well covered by earnings and cash flow. The dividend infrastructure is intact, and the volume recovery provides a near-term growth catalyst to support the financial profile.
19 analysts cover PepsiCo. The consensus lands at moderate buy, 7 buy ratings, 10 holds, and 2 sells. Average price target around $166, implying about 5.5% upside from where the stock sits today.
The range of views is interesting. On the bullish end, UBS has a buy with a target of 186. Citigroup is also at buy with 182. More cautiously, Barclays is at equal weight and TD Cowen has a hold. Deutsche Bank maintained its buy rating but trimmed its target from 176 to 169 in March.
What was the reaction immediately after the Q1 report?
Generally positive but measured. The beats on both EPS and revenue were well received. The PF&A volume inflection was the specific data point that generated the most enthusiasm. Analysts had been flagging that metric as the key watch item for consecutive quarters. The stock moved up about 2% on the day, a modest reaction for a beat of that magnitude.
What tempered the enthusiasm?
The full-year guidance. Revenue guidance of $95.8 to $97.7 billion came in about $600 million below street consensus of $98.3 billion. Management typically guides conservatively, so some analysts are willing to look through it, but others flag the gap as a signal that top-line momentum may be slower to build than expected.
Let me run the bull case. Start with the PF&A volume turnaround. After 2+ years of consumers trading down on snacks, volumes in North America are growing again. 300 million new consumption occasions year over year, and shelf resets and innovation launches haven't even fully rolled out yet. Those are completing through Q2, so there's runway still ahead.
The international leg is the second pillar of the bull case. EMEA and Asia Pacific both delivered 7% organic revenue growth in Q1. India is emerging as a high-priority growth market. That geographic diversification is a genuine structural strength when any single region stumbles.
Third is the functional beverage expansion. The Poppi acquisition and Alani new distribution put PepsiCo squarely in prebiotic sodas and premium energy drinks, the fastest-growing beverage categories. Those carry higher prices and have margin expansion potential over time.
And then there is the defensive income argument. 53 years of dividend growth, a 3.6% yield, and nearly $9 billion in total shareholder returns planned for 2026. In an uncertain macro environment, that's a meaningful floor for investors seeking stability.
Now the bear side. Lana, where do you push back?
Start with the guidance miss. Full-year revenue guidance came in below consensus. That gap matters because management at companies this size typically has strong visibility. If they're guiding $600 million below Wall Street, that's a signal worth taking seriously.
What else?
The margin compression risk. The volume recovery in snacks came from cutting prices. That's a margin for volume trade-off. If input costs stay elevated, or if competitors respond with their own price cuts, the margin recovery could be slower or shallower than the market expects. The 88% dividend payout ratio is a tight buffer.
And the balance sheet concern is legitimate too.
$52.7 billion in total debt, with quarterly interest expense running at $300 million per quarter, limits strategic flexibility. If the macro turns sharply negative, PepsiCo has less room to maneuver than a less levered company. The geopolitical uncertainty management flagged in their Q1 commentary, ongoing global conflicts, volatile macro conditions, is a real headwind for a company with over 40% of revenue outside North America.
How does PepsiCo stack up against its peers? The obvious comparison is Coca-Cola, ticker KO. KO trades at a significant premium, about 6.6 times sales versus PepsiCo's 2.26 times. Coca-Cola projects 4 to 5% organic revenue growth, which is faster than PepsiCo's 2 to 4% guidance. The premium is partly justified by KO's simpler, less capital-intensive pure beverages model.
Mondelez International, ticker MDLZ, is a closer comparison on the snacks side. They trade at about 1.85 times sales, cheaper than PepsiCo, and are projecting roughly 5% revenue growth. Their price-to-earnings ratio is around 28 times, making them look more expensive on an earnings basis. Strong brands, solid execution, but less geographic reach than PepsiCo.
Then there's Kraft Heinz, ticker KHC, which is the deep value end of the spectrum at about 1.2 times sales. But that valuation discount exists for a reason. Revenue is declining, and their organic growth outlook for 2026 is essentially flat to negative. Different risk profile entirely.
PepsiCo sits in the middle. Not the growth premium of Coca-Cola, not the value trap risk of Kraft Heinz, and somewhat cheaper than Mondelez, with a broader geographic footprint and a recovering North America business. That positioning makes sense for an investor who wants defensive income with a recovery catalyst built in.
What was the options market signaling heading into Q1 earnings?
Options implied a 4.3% move in either direction on the earnings announcement. That was actually below PepsiCo's historical average post-earnings move of 5.4% over the prior 4 quarters, suggesting the options market was pricing a contained, orderly reaction. Put-call ratio was near parity at about 0.92.
Which turned out to be exactly right. The stock moved roughly 2%.
Correct. Call open interest was clustering around the 160 and 165 strikes, pointing to modest institutional bullish positioning. Put protection anchored around 150. The post-earnings implied volatility crush was the expected outcome, and that's what played out. Nothing dramatic in options land for this one.
Any notable insider activity over the past few months?
Nothing discretionary. The only transactions in the past 90 days were RSU grants to senior executives in March, standard equity compensation, roughly 38,000 restricted stock units awarded to the senior VP and controller as part of their annual comp cycle. No open market buying or selling.
That quiet is pretty typical for a company of PepsiCo's size mid-execution on a strategic pivot. Management tends to be very deliberate about optics around compensation during periods of strategic transition.
3 things to watch closely for PepsiCo from here. First, whether the North America volume recovery sustains through Q2 and Q3. The shelf resets are still rolling out. If consumer response doesn't hold once the promotional activity normalizes, the bull thesis develops a crack.
Second is the guidance trajectory. Management guided below street consensus for the full year. If they have to lower that guidance in Q2, that's a stock down event and a meaningful test of investor confidence in the recovery narrative.
Third is the international macro environment. Management explicitly cited ongoing geopolitical conflicts and macro volatility in their Q1 commentary. For a company generating more than 40% of revenue outside North America, that's not a boilerplate disclaimer. It's a real risk they're flagging to the street.
And free cash flow generation through the year. That Q1 operating cash flow of $41 million needs to recover sharply in Q2 and Q3 to fund the dividend and repurchase commitments. Let's bring it all together. PepsiCo delivered a solid Q1 2026. Beat on EPS, beat on revenue, guidance maintained. The North America snack volume inflection, the metric everyone had been watching, finally materialized. 300 million new consumption occasions and the first positive volume growth in over 2 years.
The financial profile is intact. 54% gross margins, $10.5 billion in cash, a dividend growth streak of 53 consecutive years. The debt at $52.7 billion is the main structural concern, but interest coverage at 12 times provides adequate cushion.
The path ahead is about proving the volume recovery sustains. PepsiCo bought volume with price cuts. The market wants to see that volume stick while margins begin to recover. That's the Q2 and Q3 story.
The primary metric to track: organic revenue growth in North America foods and beverages. Above 4% by Q3 confirms the recovery thesis and opens the door to multiple expansion. Sustained below 2% means the stock likely stays range-bound at current levels.
We close every episode with a quote that fits the story. Warren Buffett famously said, "Price is what you pay. Value is what you get." For a company that just deliberately cut its own prices on Doritos and Lay's to buy back consumer loyalty, there's real weight in that line. LaGuardia made a calculated choice to sacrifice near-term margin for long-term volume. The bet started paying off in Q1. Whether the value shows up fully in the stock depends on what happens over the next 2 quarters.
And it's worth remembering that Buffett himself held PepsiCo in Berkshire's portfolio for decades. The brand compounding story is exactly the kind of durable advantage he looks for.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No signup, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.